so delighted to introduce our speaker. Number one, because he belongs to the Tea Party, he's a member. And number two, because he has a lot of knowledge about the financial affairs of this country and has done a lot of study on it. And even though he has a brand new 2-month-old daughter, Riley, who probably is keeping him up a little late at these nights, but I'm delighted to introduce to you and tell you you'll have a chance to question him out with Pete McDonald. Pete?
Well, actually, this is my first opportunity to be tall. It's a lifelong dream of mine. So I'm going to go ahead and take advantage of it. You will find me, though, I will move away from this podium. I get a little bit animated. The information that we're going to be discussing today tends to be a little bit dry, but I think it's absolutely imperative that you understand the Fed, who they are, where they came from, what caused their current policy and what drove their current policy. It's changed dramatically from 1913 when it was adopted to what it is today. And I am going to do my best to keep you awake. I know after lunch and talking about the Fed, well, hopefully I won't catch a couple of you dreaming that you were somewhere else. But here's what I am going to discuss today. I'm going to take a Fed 101, an explanation of who they are, a more educational based. I am not going to stand up here today and try to change your mind of whether the Fed should be in existence or not. I think first you must be armed with the information of who and what the Fed is before you can make a decision of whether or not they should still exist. The creation of the Fed came out of the late 18th and 19th century. During that time, we saw financial institutions bankrupting, small business owners bankrupting. It caused quite a bit of concern for our congressional leaders at the time. To give you just a basis of what the Federal Reserve is, it's a monetary system that we now have in place. There were many monetary policies and institutions before the Fed, and some of them worked quite well. Most of you may have heard of the gold standard. The gold standard was in place for 100 years before the adoption of the Federal Reserve. 1971, the gold standard was eliminated, and we moved on to the Federal Reserve System, or what some call the terminology is a fiat system. It's a money, paper-backed system that is backed by the full faith and credit of the government, which may mean different things to you and me. Starting back in 1907, there was a panic during that time. There were run on the banks during that time. The gold standard had its place, but it also had issues as far as Congress was concerned. These recessionary dips that occasionally occurred, there wasn't a way for liquidity to come out into the market at these times to help run on banks, to provide liquidity to these banks to be able to keep up with the withdrawals as they were coming out. So Congress in 1907, they began the process of looking into ways to fix this issue. It took quite a few years and a lot of debate before the Federal Reserve became the solution to the issue. That was put in place December 23rd. This one here?
Yes,
sure.
It's creating the problem.
How are we now? Back to short. It's okay. 1913, December 23rd, President Woodrow Wilson signed into law the Federal Reserve. The Federal Reserve at that time had very few policies or there wasn't a whole lot that they did other than providing liquidity to the market in emergency situations. In fact, it was to work as a subordinate to the gold standard. Things change. Their policy of monetary policy didn't really come to the forefront until about 1935 with the Bank Act of 1935. There was a few things that's a big part of history. I'll go through a couple of the laws and some of the major impacts to the laws as how it developed the Fed's current policy and during that time. The Banking Act of 1935 was one of them. There was a lot obviously going on from the 1913, from the establishment of the Federal Reserve. One of the first things the Federal Reserve was adopted to do was to finance and help to secure the Treasury bonds to be sold to help finance the war in World War I. So it started in financing war. And that was one of their first major duties. During that time frame, we were still seeing up and downs in the markets. It wasn't a perfect system. But the Fed learned a lot of their current ways of pushing policy during those time frames as far as the 20s and 30s are concerned. The Federal Reserve Bank became operational during World War I, like I said. The first major task was to support the U.S. Treasury's wartime financing needs. Most of the credit created after the war. From 1918 to 1920, to support Liberty loans, the government floated to help finance the war and its aftermath. The 1920s, both the Fed banks and the Federal Reserve Board argued that banks' constant presence in the money market was necessary to prevent crisis. Well, that's what they're doing today. So that hasn't changed. I guess they're effective at it. Again, that's up for negotiation and argument. In the 1920s, during that time frame, exports of goods and capital to Europe burgeoned as gold flowed into the Federal Reserve to pay balances down on loans, and also as they were purchasing our exports to fund their war efforts. Gold was flowing from Europe and into the federal banking system. Most of those deposits ended up in the federal banks. Step back for a second so you understand the Federal Reserve banking system, the way it's set up. There's 12 Federal Reserve banks located in different districts across the country. Most of them are in large cities. The largest of those Federal Reserve banks is in New York. The second would be in Chicago. It is set up, or the current structure of the committee that we look to right now for information, and Ben Bernanke as our chairman. That came out of the 1935 Act. I'll go back into that. The president has the power to appoint those individuals. 7 of those members and 5 of the presidents from those Federal Reserve banks. It is by law that he must appoint those presidents in regards to industrial, agricultural, financial, so that it gives it covers all folks in the nation. That's the design. The President of the United States is the most powerful man in the world. We all understand that. And it's been said that the Fed chairman is the second most powerful man in the world. Most of us really don't know who Ben Bernanke is. I will go in a little bit about who Ben Bernanke is, and we'll talk a little bit about some of the chairmen as well. But I do think you should understand that as we realize the most powerful man in the world should only serve for 8 years and no longer. The second most powerful man in the world can serve up to 14 years. So if there's any argument of whether there's some change needed within inside of the Fed, I think the first thing I would do would limit that term a little bit. 14 years is quite a long time to drive monetary policy. Moving ahead, through the years. I will go back into some of the laws and describe some of the laws that had shaped monetary policy. But I do think it's important to understand that this power that was given to the Fed had been created by Congress. The laws that they enacted eventually kept empowering them to the point of where they are today. From 1951 to 1970, the Fed policy became very ordinary. We saw that in 1964, President Lyndon Johnson's government spending programs for welfare and Vietnam War again put pressure on the Fed to keep interest rates low. Again, sound familiar? I think it's absolutely vitally important for you on fixed income to understand what keeping the Fed rate low will do to your retirement, to your fixed income, especially for those who plan on living a long life in retirement. I could talk to you later about it, but I think that is an important piece that you must understand in your portfolios, is what the Fed is currently doing to you and to your retirement. Into 1970, President Nixon appointed Arthur Burns. Arthur Burns is somebody I have done a little bit of research on, and he summed it up, the Fed's issues during this time frame. And as some of you remember, obviously inflation was incredibly high during that time frame. The 1970s into the 80s, well, you could get a CD at 15%. I'm sure some of you wish that you still had some of those CDs, but I guess 0.5% will work for now. As the Feds grew in strength and power, this is a direct quote from Arthur Burns. This actually comes out of The Anguish of Central Banking he wrote in 1987. And I like this quote because I think it fits why we're here. Current and thought and the political environment they have created give rise to government spending programs and federal fiscal deficits. The Fed has the power to abort inflation at any point. That's, I think, one of the problems with the Fed right now is they've got too much power. And in fact, they could end it at any point. And Arthur Burns realized that they could end inflation at any point. But it is illusory to expect central banks to put an end to inflation that is continually driven by political forces. Why do I see it very difficult for the Federal Reserve no longer to exist? Well, because the political powers that be use it as their piggy bank. And to try and to stop that is going to take some time. I don't see an automatic end to the Fed at any point. Their usefulness, again, you can argue whether they've become useless or useful. What I'll tell you is, whatever it takes to get the Fed under control, it is going to take some time. There is no doubt about it. There is no quick fix to what we're up against right now. Again, I don't want to bore you with too many of the details. As far as Alan Greenspan's Fed, we all, during that time frame, the name the Fed and Alan Greenspan were linked together. You really couldn't separate the two. Alan's policies are still in place today. Ben Bernanke is a student of Alan Greenspan. I do consider us still in a Greenspan policy and monetary policy. For those of you, kind of just quickly give you an idea of, in case you don't understand what monetary policy is, I'll give you the correct definition. The actions of a central bank, currency board, or other regulatory committee that determine the size and rate of growth of the money supply, which in turn affects interest rates. Monetary policy is maintained through actions such as increasing the interest rates or changing the amount of money banks need to keep in the vault. What that means is they've got two tools. They've got really their balance sheet, and they've got the Fed rate. The Fed rate, what that is banks loan to each other, typically overnight, uncollateralized loans. When a Federal Reserve Bank has a surplus of currency, and there's another bank that needs to fulfill their requirements and limits, this bank can loan to this bank and for a rate. And that is, in general terms, what the Fed rate is. The Fed rate absolutely impacts short-term savings and short-term savings vehicles, CDs, money markets, checking, you name it. The idea of keeping the Fed rate low right now is to inspire you to invest your money. Inspire you and those small business owners out there to hire more people. What the Fed wasn't able to do was change the human response to what was going on in 2008. Again, they also were impacted by the laws that were put in place during the recovery situation, the recovery scenario. Obamacare being one, and the Dodd-Frank bill being the second largest piece of legislation that has impacted what's going on currently today and why you are not investing your money. In some places I don't blame you, but I still fear for you if interest rates continue to stay this low and you are on a fixed income. There are other solutions out there, but I don't blame you for holding on to your cash. I really don't. A couple of big changes in history going back to law and the key laws that affected the monetary policy. What the Fed learned during these ups and downs as the market is they pumped money into the market, similar to what they're doing now. That would cause you to invest your money, that would cause growth, that would to bring down inflation, or excuse me, to bring down unemployment, and to keep a healthy inflation rate and a healthy unemployment rate. This happened multiple times from the 50s, the 60s, the 70s, and through the 80s. They continued to use that policy as a way to try to provoke the market to move forward, and we're seeing that right now today it's not necessarily working as well as they'd want it to. Not going too deep into it again as far as blowing bubbles, because we've all heard that term as far as blowing bubbles, and the Fed's really good at blowing bubbles. It's arguable whether they are at full cause for some of these bubbles, but take into the real estate bubble that we just experienced. Now, the real estate bubble that we just experienced, that started with an easement of money into real estate. Folks who could not afford to purchase homes were given an opportunity to purchase. The money was made available by the Federal Reserve for these people to purchase their homes. Just like they've done in the past, when an influence of money goes into the market, it causes inflation. Your price in your home started moving forward faster than you had ever seen. It was only a matter of time before that bubble would burst. I'm not going to go too much into the details of where we are right now with the next bubble, but I can make a pretty good argument that gold might be the next bubble, artificially blown up by the Fed for intentions that I certainly don't know, but some of you may. I don't. How the government uses the Federal Reserve, I think, is what is at the basis for the anger towards the Federal Reserve. It's a blank check in the sense the politicians believe that they can finance anything. All they have to do is sell some U.S. Treasury bonds to the Federal Reserve, and the Federal Reserve will buy up their bonds, as many as they'd like to sell. Then the politicians can take this money and they can spend it as they see fit, whether it be war or pet projects. Pet projects, we'll talk a little bit about those. We'll talk about the Department of Energy using your taxpayer dollars to fund highly aggressive green companies. I'll take a bipartisan stance on this because that was made available during the Bush administration, and well, it's come to fruition here in the Obama administration as far as really what that money has done for you. And in fact, that'll drive me in the direction of where we want to talk, where I want to really get into the guts of where my expertise falls. I'll be honest, I don't have the PhD in the Fed. I've done a lot of study on the Fed. In fact, there's a few people in the room I've talked to who have an incredible knowledge of the Fed. But where my knowledge comes into is the private sector and into using money, taxpayer dollars, to finance highly aggressive technology companies. I believe in the free market. I believe the free market works. And when you have administrations that are willing to tap into the Federal Reserve as they see fit, to use your taxpayer dollars to invest in companies that the private sector are too afraid to invest in, I think it's absolutely imperative you understand that that's your dollars and your tax dollars going into bankrupting companies. We've all heard of Solyndra, right? We know who they are? Well, I'm going to tell you a little story about them so you have the full details of exactly what happened. In 2005, the Bush administration made available financing for alternative energy companies. I believe that was 1703. Section 1703 of the Energy Policy Act of 2005 authorizes the U.S. Department of Energy to support initiative clean energy technologies that are typically unable to obtain conventional private financing due to high technology risks. In addition, the technologies must avoid, reduce, or sequester air pollutants and emissions of the greenhouse gases. In December of 2006, Solyndra applied for a government-guaranteed loan, backed by your dollars. Under the 1703 program, after jumping through various bureaucratic hoops, by January 2009, Solyndra had convinced the Department of Energy, something we may be able to live without, credit committee, that the project appears to have merit. Appears to have merit. My question is, who was their financial advisor? Appearing to have merit and having merit are completely two different things. President Obama, who had taken office in January 2009, was scheduled to formally announce the loan guarantee on March 19th trip to California. Notwithstanding the concerns of some of his House staffers, by March 20th, Solyndra received conditional approval for the loan guarantee. Again, your tax dollars being put to work in a highly aggressive, speculative market. By December 2010, Solyndra was out of cash, and it approached the Department of Energy for another loan to avoid bankruptcy. Although there was no infusion of new taxpayer money, the government worked with Solyndra, and by February of 2011, the Obama administration had restructured the original loan to Solyndra and allowing outside investors to pour another $75 million into Solyndra. Even by September 1st, Solyndra had filed for bankruptcy and laid off approximately 1,100 workers. Now, during the 2010, when Obama wanted to keep this a little bit of hush-hush before this news came out, that's I'm not going to go down that road, but that's where people are arguing that there was actually laws broken in the Solyndra debacle. I wanted to be more of an educational piece on exactly what your money's being spent on, not whether or not the current administration has committed any type of illegal actions with your taxpayer dollars. But we can talk about that later if you like. Solyndra, as you well know, it eventually did bankrupt completely. And all 2,000 jobs that the administration had falsely created were no longer. Where it gets even dicier, as far as I'm concerned, as to what actually took place, is that the private investment groups that provided that $75 million You ever heard of a super PAC? We know that, well, Obama might be looking at getting into a super PAC, and there are other. We know that Romney and everybody else has super PACs as well. Well, what you maybe not know is that that organization or private investment group actually was able to put themselves ahead of you as far as the bankruptcy was concerned. Those private investors would receive back the money lost in the bankruptcy before you. The reason I wanted to bring this up is because there's a direct correlation between the spending of our politicians right now. This happens to be one that's glaring in the media now. The deficit is created by our politicians. The current structure of the Fed allows our politicians free rein with your taxpayer dollars. I absolutely think that it's necessary that we put the Fed up on a pedestal and start asking them some serious questions about what they are financing. It's imperative to the long-term stability of this market. I focus on this as well because as an investor and as a steward of my client assets, it appears that the ball game that we've come to know is not a level playing field. When the government has the opportunity to pick winners, that's not a free market. It's not a free market in any way. I want this to be a lesson, and I ask from the Tea Party to spread this type of information to anybody who is willing to listen to it. This is why, personal belief, we should at least be looking to see if there is a better way. I don't know. I'm, again, not the most brilliant economic mind in the world. They're usually over there at Goldman Sachs, figuring out ways to sell things to one client and sell the other to the other client. It is true, a lot of Goldman Sachs folks come out and become part of the Federal Reserve or get nominated to those positions. They are brilliant, but they are just as interested in making money as all of us. They just simply play in a different ball game than we do. I glossed over some of the things that took place in the 50s and 60s and 70s. I really didn't want to get too technical as far as monetary policy. That's up to you to really get to understand exactly the inner workings of the Fed. I would bore you to death if I tried to give you every little bit of detail. I wanted to really focus on the fact that there are other ways out there that have worked in the past, and there may be a better way of doing things. I don't know that. But open up your mind, and it's collective groups getting together and coming up with good ideas. That's where solutions come out of. And that's one of the reasons I like and love being a part of the Tea Party, is because I get a chance to hear some incredible ideas. And I'd hope that our politicians open up their ears and start listening to some of the ideas that are coming right here from these tables. It's pretty impressive. Here in this room, there are some individuals who have an incredible grip on what's going on, especially in regards to the Fed. I've spoken with a few of them, and I learned a few things from them as well. So with that being said, I hope that was somewhat enlightening. I know the information is, it can be dry. I tell you, it did take me 2 years to read through some of these books because of the dryness in a lot of this, but it has a huge impact to where we're going. It has a huge impact. I see myself as a steward of wealth. You created your wealth. It's my job to manage it. It's my job to make sure that it lasts forever. And I'll tell you that my job has gotten incredibly difficult over the last few years, and not necessarily because of the volatility in the market. It's because of the current interest rate environment that we're in. Fixed income is an important topic, but you must also realize the impact to the insurance companies right now that these low rates have. The guarantees that some of your insurance products have are unsustainable, or they're not going to be offered to the next generation of folks. And I think it's imperative that you understand what that does to wealth. And again, thank you. I hope that was informative.